Hello, and welcome to the Friends of Sanctuary podcast. I'm Marianne Bartels, Chief Investment Strategist at Sanctuary Wealth. Today, I'm pleased to welcome our guest, Bob Stein, Deputy Chief Economist, First Trust Advisors. Bob, thank you so much for joining us.
It's a pleasure.
You know, Bob, there's a lot going on, and I was so looking forward to our conversation. Let's talk a little bit about the economy. A lot of people were concerned in the beginning of the year after Trump initiated tariffs that it was going to throw us into a recession. Obviously, Trump dialed back. If you look at the Atlanta Now GDP tracker, it's showing us growing way over 2%. Where are we in the economy? Because now we have tariffs again. Should the average investor really be nervous about the direction of the economy?
So as an economist, I'm going to speak out of both sides of my mouth, Marianne. So what I think is that the odds of a recession are below 50%. That means the odds of a recession starting anytime between today and the next 12 to 15 months are below 50%. Probably we won't have one. But I also at the same time think they're higher than the markets are currently pricing in. And here's why. The last two budget deficits under President Biden, in my estimation, were probably the most reckless budget deficits we've ever had, or at least in my lifetime. And I know that sounds extreme, so let me explain it. We had a president in the 1980s, Ronald Reagan, consistently criticized by all sides for running overly large budget deficits. And yet the largest deficit Reagan ever ran, was 5.9% of GDP back in 1983. But in fiscal 1983, the unemployment rate was 10%. So he had an excuse. The last two budget years under President Biden, we had an unemployment rate on average of 4%. Makes no sense to me to run larger and larger budget deficits, 6.5% of GDP, even larger than the largest we ever had under Reagan, who, by the way, was fully funding the Pentagon at the height of the Cold War, when the unemployment rate is 4%. But I think the enormity of those deficits the past 2 years hid or masked some of the pain we will eventually feel from the tightening of monetary policy over the past couple of years when short-term interest rates went up until recently, and when the M2 measure of the money supply fell and now has risen gradually for the past year. So I still think there's some pain to be felt. Again, odds of a recession below 50%, but higher than the market's pricing in. You mentioned tariffs. Let's talk about tariffs. I actually think the upside risk to inflation related to tariffs is overestimated. I'm not that worried. There should be a little bit of upward price inflation related to the items that are being tariffed, obviously. But if that doesn't change the money supply, then the amount of money that consumers and businesses have to purchase other items is going to fall. So I think that's an offsetting effect. The big problem to me is the volatility in policy, because the idea behind tariffs, and I'm not saying this works completely, okay? I'm not a protectionist, but the idea behind tariffs is let's raise tariffs and get more business investment into the US, more production in the US of those goods that are now being produced abroad. But if you wake up one morning and the tariff is 50%, and then 2 weeks later it's 150%, and then 3 weeks later it's 25%, and you have no idea what they're going to be, then you as a business are going to be reluctant to bring production back home because you don't know whether the tariffs are going to stick. So I think the downside risk to the economy related to tariffs is actually greater than the upside risk to inflation over the next year or so. And so again, I think the economy is okay right now. I do not believe we're in a recession right now. Obviously, in the second quarter, with the trade situation, we're rebounding from the negative growth in the first quarter. We weren't in a recession in the first or the second quarter. But again, I think the downside risks are a little bit higher than the markets are currently pricing in.
So let me backtrack on inflation, because today, as we're recording, we just got the Consumer Price Index, the CPI number, a little bit hotter than expected. Do you think that can continue for a few more months because of the tariffs? The market seems to be shrugging it off. Both the equity market and the fixed income market didn't seem to be bothered by the CPI number. Is that the correct reaction?
I think it's a correct reaction because if you look at core prices, they were up only 0.2, not the 0.3 that the market was anticipating. And in addition, we've had tariff talk ever since Trump took office. And if you look at the past 5 months of price increases from January to June, using January as the base, so 5 months so far of his presidency and inflation data, overall consumer prices are up at a roughly 2% annual rate. And core consumer prices are up at a 2% annual rate. And so I really have not seen the effect yet of these tariffs on inflation. Now, here's the problem, Marianne. Over the next several months, the year ago comparisons for prices are going to consistently be, July to July, August to August. Well, we had really low inflation at the same time last year for those particular months. And so the year ago comparisons are not going to improve. I would advise investors to instead look at the 6-month annualized rate for prices over the next few months. And there, I think you'll see us getting astonishingly close to the 2%
Like
target
a
on
3-month
inflation.
moving average kind of thing.
Yeah, 3-month, 6-month moving average, rather than the year ago comparisons, which I think are artificially going to make this year's inflation numbers look high. If you look at the 3 and 6 month annualized, I think it'll show that the Fed really has a moderately tight monetary policy, and there is a little bit of room to cut rates later this year.
So, Bob, one of the things that the Fed looks at, and this is getting a little nuanced, is the break-even market for inflation expectations. That seems to be the bigger concern. What are investors pricing in going forward? What are you seeing in the break-even market?
When I look at the break-even market, I don't see anything outside of the range of the last several years that should disturb the Fed. Basically, we've been hovering in the range of 2.5% for a very long time. I would think that the Fed should become uneasy if we're persistently seeing 3% or above for break-even inflation, which is the market's expectation of what inflation will be in the 5-year period starting 5 years from now. I think that's the most important part to watch. And that they should be a little disturbed if we go below 2%, assuming they have a 2% target on PCE, 2% CPI expectations would suggest they're probably overly tight given their monetary goals. I haven't seen anything recently that suggests we're going to a hurdle outside of that range. I think it's important to look beyond things that simply confirm our view. It does confirm my view. I always try to find a reason why my view is wrong. That doesn't suggest it's wrong, but I'm sure there are other things out there that will make me think about where my forecast is.
So let's talk about the big, beautiful bill. That uncertainty for the market is over because now that it's signed. And I think if you're a Wall Street person, you like the bill because there's spending in it, and spending is good for risk assets. But you hear some horror stories of some of the things that are being cut from the bill. What's your general outlook from the big, beautiful bill?
Marianne, I have rarely, if ever, seen more talk about a bill that does so little relative to the amount of chatter about it. Okay, now I'm not saying it's not a good bill. It's a bill that, had I been a member of Congress, I would have voted for. I think we do have to get the entitlement state under control. And so I like some of the cuts to Medicaid. I think that's okay. I think you can still deliver care to people in need within the confines of the current budget structure, and maybe even limiting it a little bit more. I also like the extension of the tax cuts. With the tax rate structure that was enacted back in 2017 has now been permanently extended on the individual side, not just on the corporate side. And we also have permanent enactment of bonus depreciation, as well as the expensing of research and development. All of those are good things. They're not dramatically different than the world that we live in today in terms of current policy. So this prevented a major tax increase from being passively enacted on January 1st. If we had done nothing, we would have had a big tax increase. But it's not a major transformation of the tax code. And so you have a lot of political conservatives, Republicans out there talking about this bill as if it's going to unleash a new era of prosperity, that it's basically turning the United States into a land of milk and honey for all. Well, it's not that much different from what we have today. If it's going to deliver that, why don't we have that today? On the other hand, you have some other people on the other side of the aisle, Democrats and very liberal citizens and hard left even, saying that people are going to be dying in the streets because of the cuts to Medicaid. Well, if you look at the budget, I think spending grows at an average annual rate of 4% over the next decade, rather than I think it's 4.2 or 4.3% over the next decade. That's growth. 4% growth in total outlays versus 4.2 or 4.3%. That's not going to lead to blood in the streets either. So I think both sides, for whatever political reasons they have, are grossly exaggerating to the upside and the downside the effects of this bill. If I didn't know this bill had happened, and I just assumed that whatever current policies in place continued in place, we wouldn't that much know the difference. But I think for their own sides, they have to proclaim it as greatly good or greatly evil in order to generate donations to their campaigns.
Well, particularly since we have elections coming up, but we're gonna get to that. You've actually have spent some time in Washington. Why don't you tell?
Unfortunately, so, Mary.
And you even live down in that area. Can you tell our listeners and our viewers a little bit about your background from Washington?
Sure. I spent 7 years on Capitol Hill as an economist. The first 5 working for the Joint Economic Committee, as well as the Senate Banking Committee as a staffer, covering monetary-related issues. And then my last 2 years on Capitol Hill were 2001 and 2002, when I was working for the senator from New Mexico on the Senate Budget Committee as the chief economist. And it really taught me a tremendous amount about the budget process, as well as how to analyze the budget data in a way differently than most people do. When you look back at it, though, I want to bring this out, Marianne. Okay, so I'm talking 1996 to 2002. What did we have during that period? We had a budget surplus. I'd like to take personal responsibility for the budget surpluses.
That was under Clinton.
Clinton, right? As well as the early days under George W. Bush, before it was squandered in Iraq and the recession and everything like that. And then I went to the Treasury Department for 4 years. So I was there from 2003 through the end of 2006, working on a variety of macroeconomic issues, including forecasting and policy analysis as well.
And I think that's important based on your comments on the big, beautiful bill, that you might have a little bit of a Washington inside bird's eye view of what this bill really does mean for the economy.
That's right.
But it is a net spending bill, if I'm correct.
In the early years, there is more spending than would otherwise be the case, largely related to border security and things like that. But spending will be higher because of this bill than it otherwise would have been. However, and this is very important, Marianne, this is like the kind of juicy stuff you'll follow later this year, which is the Congressional Budget Office at the very beginning of this year forecasted that social discretionary spending, so not the entitlements, not net interest, not the Pentagon, social discretionary spending would be about $1 trillion for the fiscal year that starts on October 1, like this October coming up. President Trump a couple of months ago made a budget request of less than $700 billion for that $1 trillion worth of programs. That's approximately a 32% cut when you do the math out. Now, he's not going to get everything he wants, not even close. But I do think he gets most of what he wants. Now, there might be an emergency that comes along that he has to deal with that boosts spending. That happens from time to time. Floods, tornadoes, hurricanes, whatever. Okay.
Well, we seem to be having a lot of those these days.
Exactly. Earthquake, whatever. So he's not going to get everything he wants. But I do think we might actually get a roughly 20% or so cut in social discretionary spending for the fiscal year 2026. Now, that's not in the bill. That was just passed. In the meantime, we're getting more tax revenue. So from a fiscal standpoint, again, not from the big, beautiful bill itself, but from a combination of that tariffs and Trump aggressively going after social discretionary spending that has to be annually appropriated later this year, we're getting a more contractionary fiscal policy than a lot of people realize. And I think that's also, at least in the near term, a little bit of a downside risk for the economy that is yet to materialize.
So when I looked at some of the estimates that have come out on tariffs, because you brought that up, the revenue so far that we've brought in is almost $100 billion.
Mhm.
I think Treasury Secretary Bissent is on record that he's estimating by the end of the year we might bring in about 300 billion in terms of revenues from tariffs. What does that money get used for? Is that a positive? Does that offset part of the deficit?
Well, it will offset part of the deficit. I mean, my estimation is that we'll probably take in somewhere a little above 200 billion annually with Trump tariffs and all the volatility with Trump tariffs, more than we otherwise would have in the absence of President Trump as President Trump. So that will go into general revenue, and that will reduce the deficit compared to what it would otherwise be. However, and this is important, okay, that doesn't mean the debt goes down. That just means the debt increases at a slower pace than it otherwise would. It's part of a fiscal contraction. Because remember, fiscal policy affects the economy, as you know, Marianne, not by, you don't have to have a surplus to have a contractionary fiscal policy. You just have to have less of a deficit than you had the previous year. And that's sometimes a little bit tough for the economy to take.
Do you think, though, that the market, and I'm really referring to the equity market, and I know you're not an equity market expert,
Mhm.
but do you think maybe the market's not appreciating the revenue that's being generated by
Bingo.
the tariffs?
They're not appreciating it fully. I think fiscal policy is more contractionary and will be more contractionary later this year than the market is currently pricing in. And it doesn't fully appreciate that. We probably disagree with this. I think the market is a little bit frothy. I like to follow the Shiller PE ratio, taking 10 years of earnings. And I know it's a flawed measure, but you take the 10 years of earnings, inflation adjusted back earnings, we have a Shiller PE ratio of approximately 38. And that, to me, does not correspond with high future returns. Now, past performance is no guarantee of future results. It's entirely possible that we have a Shiller PE ratio of 38 today, and 10 years from now, I'll be looking at my chart where I relate where the Shiller PE ratio starts out and what the future return is on the S&P 500, including reinvested dividends, and I'll be marking a 15% return 10 years from now. Based on past patterns, I don't think that's likely. I think we're going to have positive but substandard returns on average for the next 10 years. That doesn't mean bail out of equities by any stretch. I'm in equities, but I own a little bit less. I'm a little less exposed to equities than I normally would be, given my age, unfortunately advanced. At my age, my risk profile, my financial goals. So I would be a little more interested in hedging, buffering, a little more interested in fixed income and alternatives.
Well, there's income that is finally generating in fixed income for clients, correct?
Yes. Yes.
So when you're really putting a portfolio together, you can build in income. And now the private markets, private equity, private credit, are also being added to diversify and add return. But from my perspective, can I ask you, when you have free time, and I know you're very busy, I am happy to share a chart with you, one of my favorite charts. And it's actually the log of the S&P PE ratio.
Mhm.
And what I have found, because I do a little bit of charting, I have a little bit of background in charting, is that PE multiples expand in secular bull markets,
Mhm.
which I believe we're in. And I believe because of all the funding that you talked about in terms of Biden, all the money that came in due to the great financial crisis, continued net positive flows of money will continue to drive risk assets. And my it's not even a concern. My prediction is that we will surpass PE multiples of 2000, that we're in the early stages because of all this new innovation with AI and robotics and blockchain and
Mhm.
crypto, that we're in a very unique cycle. But I'd love to share that chart with you.
I'd be happy to look at it.
Awesome. And then I'd love your opinion of it. I may not change your mind, but I'm going to try a little bit.
Please.
Let's talk about interest rates because, yes, clients can finally get some income generated. Can you look at interest rates today and maybe look out over the next 6 to 12 months? Where do you think the trend in rates are? I'm going to ask you a question eventually about what's happening with the Fed. It's a little bit of politics around that. But you mentioned a little bit earlier, you do think rates can come down. Can you put a little bit more context around that?
Sure. I laid out the case earlier that inflation is down, and we may actually go a little bit below 2%, given that monetary policy creates lags, or inflation reacts to monetary policy with significant lags. In order to get inflation where it is today, at least on the 3 and 6 month annualized framework, you need to have at least a modestly tight monetary policy. And if monetary policy is modestly tight already, and it takes a long time to affect the direction of the inflation rate, well, unless they change it soon, we may get below 2%, like sometime next year. In terms of where I think the Fed will actually go, I hate to be so consistent with the market. I'd like to be different from what the market anticipates. But right now, I find myself very similar, which is that I think there'll be 2 rate cuts later this year. Not in July, but in September. They'll pause again around Halloween, and then again in December they'll cut another time. I don't think it will be because of political pressure on Jerome Powell. I think it will be because the consensus at the Fed realizes that inflation is a little bit less of a problem than they previously anticipated, that a lot of the scaremongering about tariffs lifting inflation was overdone, and that they do have room to cut rates. And they'll continue to do so next year as well, but in stutter steps. And that's even if Jerome Powell is replaced next spring. I do not believe he'll be removed forcibly from office before then. I think it's a little risky for the Trump administration to try to do so.
It can create instability in the markets and the dollar, no?
It absolutely can create that instability. And it would also be a sign to the markets that whomever the Fed chairman is in the future can be easily removed, in which case there'll always be in the back of the market's mind a wonder about whether changes in monetary policy at the Fed are dictated from the White House or really based on economic and financial conditions. And that means they would have to assume inflation is going to run a little bit hotter in the decade to come. I have to say that I actually believe that's the scenario most likely to occur, but not as extreme as it would be if Trump removes Powell directly over the next several months. I mean, why not just wait? The guy's leaving next spring anyhow. His term as chairman runs out, and he'll leave at that point. If they try to remove him, they might get pushback from the courts temporarily, which allows Powell to remain as chairman anyhow, in which case he might be more reluctant to cut rates, staying in office only because of a court stay than he otherwise would be. Why would the Trump administration court that? So I think in the end, they probably won't try to remove him. If they do try to remove him, the courts will probably at least temporarily intervene to keep him there. And regardless, the administration will put somebody new in there next spring.
But for our listeners and viewers, it's really a committee that decides the direction in rates. The Fed chair may try to guide that,
Yes.
right, and try to push for their opinion, but it's the committee's decision as to the direction of interest
That's a great
rates.
point, Marianne, because that brings me to another point, which is that let's say he removes Powell successfully and the courts don't intervene or only do so temporarily. You could have people at the FOMC, the bank presidents and the members of the board of governors who are actually voting on policy, who privately think, well, it is time for a rate cut, but we're not going to give it to the president because he removed Powell. And
it becomes political.
Exactly. And so they'll find a justification not to cut rates when they otherwise could have. So that's a downside. That's another downside risk of Trump actually trying to remove Powell. What if he's successful and the remaining people, is he going to remove everybody? That would be very disconcerting for the markets. So,
do you ever look at China?
I do look at China more from a geopolitical standpoint than.
Because my question would be, there's a lot of concern about the weakness in the economy there. There are some economists saying that they're in a deflationary environment. We're seeing their prices go down, and that may eventually affect the United States. Do you incorporate that into your analysis?
Very little, very little. We've seen in the past where on a secular basis, definitely China has an impact on the direction of inflation in the U.S. In part because if the prices of Chinese goods go down, that's more competition for the U.S. It could lead to a shift in monetary policy in the U.S. So ultimately, I mean, inflation in the U.S. is a monetary phenomenon, but China can influence what's going on in the real economy in the U.S. However, I don't think the effect is that great. One thing a lot of people overlook, yes, we're importing a ton from China, not as much as we were a couple of years ago, but we're still importing a lot. We export to China about as large a share of our economy as we were exporting to Japan in 1990. Okay, now Japan and their economy imploded in the 1990s. They had many years of negative economic growth. They had a bubble in real estate that collapsed that made our bubble look small by comparison. And we had a great decade in the 1990s. So I'm not that worried about China because we don't depend on them as much for selling goods or even services as we do for many other countries around the world. Now, if China were to hit a sudden, unique, and for unique reasons, some sort of financial depression, I think it would be a negative for the U.S. But it would be much more of a negative for other countries around the world than the U.S. I mean, Japan's implosion in the 1990s certainly affected other countries as well.
Let's look at our national debt, the overall big picture. I think it's around $37 trillion. It's one of the largest deficits that the United States has ever had. Does that worry you? Or do you think that the Trump policies over time will allow that to come down? Meaning all this new AI innovation and crypto and maybe the big beautiful bill allow the US economy to grow. So maybe one day we can be like the late 1990s, early 2000, and maybe go to a surplus. No one talks about potentially going into a surplus, or is that just a dream?
I think that's just a dream. So here's the deal. I focused on the debt very intensively over the past 25 years. So I have very strong opinions in this regard. First thing is the best way to me to measure the manageability of the debt, it's not by looking at the debt itself, but by looking at the interest cost on the debt relative to GDP. And the reason you look at interest costs is interest is an annual flow, and GDP is an annual flow.
It's a cost.
That's right.
So that you have to pay.
That's exactly right. It's like a national mortgage payment, if you will. So for the country as a whole. So back in the 80s and 90s, it was regularly 3% of GDP. And then a lot of good stuff happened in the 1990s, the early part of the following decade. We ended up for about 25 years, only having to pay bondholders 1.5% of GDP for net interest. 25 years. I call that the era of candy, where we could cut taxes time and again. We could raise spending time and again. Democrats calling for Medicare for all. Why did all this happen? Because when the interest cost is low on the debt, politicians realize they have a lot of money lying around to buy our votes. And that's exactly what they did on both sides of the aisle. But the age of candy has come to an abrupt end, Marianne. So last year, the interest cost was back to 3%. So
which was the size of the defense budget?
Well, actually slightly larger. Yeah, we're in interest costs back to where we were in the 80s and 90s. Now, the good news, I don't think that interest burden continues to skyrocket in the years ahead. One reason is that interest rates aren't going up. Like they're not going to triple again over the last few years like they have. But the other reason is I think we're back to something I like to call the politics of limits. And you and I are familiar with the politics of limits. So let me remind the audience, 1982 to 1998, on a bipartisan basis, under presidents of both parties, we had measures taken, both partisan and bipartisan, designed to control the budget deficit. Reagan raised the payroll tax. We had Graham-Rudman-Hollings that you and I remember from the mid-1980s, designed to control the growth of federal spending. George Bush broke his no new taxes pledge, raised taxes, and set strict spending caps on both social and military spending alike. Bill Clinton raised taxes, ended up deciding to keep those budget caps that he had bemoaned throughout the 1992 presidential race against Bush. He decided to keep them, and he kept them to roughly 1998. So that's the politics of limits. That's what I think we're going back to. We've already seen it this year. Republicans are raising taxes. They're called tariffs, but they're taxes. And now we have seen the big, beautiful bill, which over the full course of the 10 years, through entitlement cuts, particularly on Medicaid, is going to cut spending. Not in the early years, because additional ICE spending and border control spending and things like that. But over the course of the full 10 years, it's going to cut spending. So we have politicians who are more focused on the deficit than they've been since the early part of the Bush administration in 2001 to 2002. So I don't think we see interest costs continuing to skyrocket.
Because we have interest rates coming down.
That's right.
And then would you expect Treasury Secretary Bessent to restructure how the government funds the deficit? In other words, taking a longer duration?
No, I've always hoped he would. I advocated it back when I was at the Treasury Department a few decades ago, but I don't think it's ever going to happen. I'm very reluctant.
Why are they reluctant to do that?
Here's why. The argument they make, and when you look at it, it's accurate. What they say is accurate, is that normally the yield curve is upwardly sloping. And so if you fund...
Meaning rates on the short end are low, and the back end is higher.
Exactly. So the longer the duration of the maturity, the higher the interest cost, generally speaking. Not always, but generally speaking. And so if the federal government finances the debt with more longer maturity instruments, more longer maturity bonds, well, on average, that's going to cost the government more. And that will add to the deficit more. And that will add to the debt more. And that's the argument they use. The green-eyed shade people at the Treasury Department. Now, what I said when I was there to them was, do you have term life insurance? And invariably they would. I said, well, chances are you're going to make all these premium payments for the next 15, 20, 30 years, and you're never going to collect on that policy. The American taxpayer, in my view, should be willing to pay a premium, somewhat higher interest year by year, for the security of knowing they'll never have to refinance the debt at an inopportune moment. Just like term life insurance. Okay, you pay a premium for a service, and that service is reduced risk. That's what the U.S. government should do, but they don't do it because they're looking at it with green eye shades, thinking about having to pay greater interest every year. I pay a premium for life insurance every year. I'll be happy if I never collect on that policy. It means I'm alive. Now, getting back to the debt, I want to tell you something. I'm going to make 3 assertions. Number 1, we will neither of us, see another balanced budget or a surplus for the remainder of our lives. Never.
That's a big statement.
Never happen again. It was a unique set of circumstances. Back in the late 1990s, early part of the following decade, you had the baby boom generation hitting their peak earning years, not doing what they're doing today, hitting the golf course and the beach. Okay, we had Medicare and Social Security were a smaller part of the federal budget back then. Now it's higher. And we had a peace dividend left over after winning the Cold War. Now we live in this multipolar world where we're probably going to have to spend more on the military. So we're never getting back to surpluses ever, like in our lifetimes. Not going to happen. Good part. We don't have to get to surpluses in order to make the debt sustainable. If we want to have interest flat relative to GDP, we need debt flat relative to GDP, which means debt can grow every year. We can run deficits. They just can't run faster than what's needed to keep the debt to GDP ratio flat. So what is that? Well, if nominal GDP grows 4.5% per year, half real, half inflation, then that 37 trillion debt can grow 4.5% per year. That's roughly $1.7 trillion. So we could make the national debt sustainable and at the same time run deficits of 1.7 trillion. Now, when I say sustainable, Marianne, I don't mean good. Okay, sustainable, good, not the same things. Okay, if I overhear my wife talking to her girlfriends about our marriage and she describes it as sustainable, okay, exactly. That would not be good for Bob. Okay, it's like something better than sustainable. Okay, but we can sustain their debt. Now, hopefully, we do things that bring the annual deficit below 1.7 trillion, and hopefully that creates a virtuous cycle that brings the deficit even lower. But the debt's not going down, ever,
Well, what
ever.
I always tell people, because when I'm sure you have the same thing, when you're talking to clients and you go to the Q&A session, the question always comes up about the deficit. It's done that for practically almost my whole career. But I always say if you can pay it, then it's fine. You can run in perpetuity as long as there's confidence that that will be paid. And I
Correct.
think that's what you're really saying.
Sustainable, not good, but sustainable. No one likes their mortgage payment. You want it to disappear overnight, but if it's sustainable, it's okay given your income.
Next year is the midterm elections. Now, I understand in the world of elections, this is way early, right? But do you have any sense yet what the midterms next year might be like? What is it for public policy? Is it going to be a grind? Do you have any expectations yet?
I do. So if you did not like the outcome of the election last year, you'll probably like the outcome of next year's election at least a little bit better. So my view on the House of Representatives is that the Democrats have about an 85% chance of taking back the House at this point. One reason is because the Republican majority is so thin. They came out of the 2024 cycle with a majority of 220 to 215. So all the Democrats have to do is pick up 3 seats. And without a defector of any kind, then that gives them the majority. Very easy hurdle to clear. Second reason, you look back historically to all the midterm cycles since World War II. And in 18 of the 20, the out party, the party not occupying the White House, currently the Democrats, wins enough to give them the 3 seats they would need. And in addition, this is not your father's Republican Party. In the sense that the Republican Party used to have a higher share of highly educated voters. Now they have a higher share of lower educated voters. And there's nothing wrong with that, except that lower educated voters, they turn out like everybody else in presidential cycles, but not so much in midterm elections or in special elections. And for those reasons, I give the Democrats an edge, and a pretty substantial one, 85%. Not a slam dunk, not a layup, but a big edge for the House. The only redeeming feature for the Republicans is that the states of Texas and Ohio may redistrict and give the Republicans, make that hurdle a little bit higher for the Democrats to clear. They may add several seats to the Republican majority just through midterm redistricting. In terms of the U.S. Senate, though, I think the Republicans are not a lock to keep the Senate, but they're likely to keep the Senate. They have to defend most of the seats, 22 seats, that the Republicans have to defend next cycle or this coming cycle. But 20 of those seats are in clearly red states. And the Democrats are going to win either 0 or 1 of them at most. They will train most of their fire instead at Maine and North Carolina. In North Carolina, I think the Democrats have an edge because Tom Tillis, the incumbent, is retiring. And in Maine, they have a fighting chance. However, I suspect that in the end, Susan Collins will keep that seat on the Republican column. She's running for re-election. That gives them an edge. In addition, she has run for re-election previously in years that were hostile to Republicans and done very well. And so I think that suggests she will probably end up keeping that seat. In addition, the Democrats have problems of their own. There are 3 purple states, Michigan, Minnesota, and New Hampshire, where the incumbents, Democrats, have decided not to run for re-election. Chances are they'll be able to keep all those seats. But because the incumbent isn't running for re-election, it's going to tax the Democrats a little bit more to keep those seats, and the Republicans will have a little bit of a fighting chance in each of them. So net, Republicans right now have 53 seats in the Senate. They probably lose 1 or 2 and end up with either 51 or 52 seats, still a majority in the U.S. Senate. If I'm right about all this, Democrats take the House, Republicans keep the Senate. What happens? Well, that means Trump has 4 years to be our foreign policy president, including to some extent on the issue of tariffs. He has 4 years to be running roughshod over the executive branch, hiring and firing whomever he darn well pleases. He's got 4 years to appoint whomever he wants, pretty much to the courts, including should there be a vacancy at the Supreme Court. But he's only got 2 years to legislate. The clock is ticking, and there are only 17 months left until January of 2027, at which point every piece of legislation getting to his desk is going to have to be at least a little bit bipartisan to get there. And that will change the scope of how much room he has for budget cutting, for example, starting in January 2027. So it's a ways off, but it's heading our way, and we know how long it takes to get there. So
Well, that sounds like gridlock. And what I know is equity markets love gridlock because
traditionally they
nothing
do.
gets done and it's status quo.
Yes.
So you do a lot of meetings, Bob. You're talking to a lot of different people. What's like one of the most important questions you think clients are focused in on?
I think I've been getting a ton of questions lately on geopolitics, whether it's Russia, Ukraine, whether it's the Middle East, or whether it's China, Taiwan. And I think the one we should probably be focused the most on is China, Taiwan, not because of the likelihood of an actual of actual hostilities breaking out, but because of the downside risk associated with those hostilities if they occur, even though the likelihood of that occurrence is low. If you actually see a shooting war between Taiwan and China, I think it would probably lead to a stalemate. I think it's going to be very tough at this point, given the innovations in defensive military posturing that have occurred just since Russia invaded Ukraine with drone technology and things like that. It's going to be very tough for China.
You think the U.S. steps in?
I don't think we step in militarily directly. I don't think we put
Like a Ukraine, we give supplies.
exactly, but the innovations in drone technology at this point, Marianne, are to the point where you can have drones underwater and sensing if the Chinese are coming toward Taiwan and then turning themselves into torpedoes to knock out their boats. Now, are we going to put aircraft carriers between or near Taiwan? I doubt it, because China could take them out with hypersonic missiles. But the odds of China actually being able to get boots on the ground in Taiwan proper have diminished greatly over the last couple of years because of the developments in defensive technology, in particular drones. So I think that's good, but I'm still worried about it, because if there is a shooting war between China and Taiwan,
Even if there's a skirmish, it's going to have a ripple effect.
it will have a big ripple effect. What if they lay siege to Taiwan and we can't get any chips out? I mean, try to buy a car or a dishwasher or a clothes dryer or even a toothbrush without those chips these days. It's going to be
Everything
tough.
has chips.
Everything has chips. And so that would be a dramatic and sudden, very sharp slowdown in the global economy, including the USA.
And for anyone that's watching or listening that doesn't know, Taiwan is the manufacturer of most of the important chips.
Thank
and
you for
that's
pointing
why
that out.
that's why it's so important. This has just been an amazing, informative conversation. So I have we're coming to an end, and I have one last question.
Sure.
What have we not talked about that you think is important for investors to know?
I think it's important to recognize that not everything is under human control. If you look back historically, there are not just climate-related events, but events from the physical world that could disturb the direction in which the United States and the world are headed. Whether it's, you look back historically at what happened in Pompeii, a couple thousand years ago. You look back historically at something like, I think it was in the 1860s, or maybe a little bit before the 1860s, the Carrington event in the 19th century in the U.S., where you had a lot of sun activity, and what if we get a multiple of a Carrington event? Because in the natural world, logarithmic event, it's better to measure things logarithmically. So what if you get something bigger than a Carrington event and it knocks out all electricity in the U.S. for a week and a half or a month? These are
Okay, even a day.
even
a day.
Think about what the United States looks like without electricity for a week.
Well, the whole world
Yes,
is dependent on electricity now.
Totally, and there are events in the physical world that can knock them out. There are events in the human world that can knock them out with like an electronic pulse attack or things like that. But just in the natural world, and things don't necessarily run smoothly in the natural world. We live in a prosperous world in large part because we haven't been hit. The Earth hasn't been hit by a major cataclysmic physical event in a long time. But that doesn't mean it can't happen. And so there are downside risks out there, like unknown unknowns, that are lurking and will from time to time happen. And we're not fully prepared for them.
but your outlook still remains positive.
Absolutely. Here's what I say, because I also get the people who are saying, our society is going to hell in a handbasket. And so
I've heard that since I'm a little girl.
Absolutely. And what I tell them is they might be right, but it's not necessarily an investable decision. And the way I put it is this. When the Roman Empire peaked and started to go into decline, they still had 400 good years. 400. That's longer than the U.S. has been in existence. So even if they're right about their doom and gloom long-term outlook for humanity or the United States, it's not necessarily an actionable investment decision-making tool. You might have a very pleasant remaining 50 years. Don't get too caught up in your personal philosophical outlook about the long term.
I think that's really important. When it comes to the equity market, what's really critical are how companies are producing earnings. Markets respond to earnings, not to what's potential. And the fixed income market reacts to the direction of interest rates.
Yes.
So, and at least right now, I think we have both of them, at least in a check mark. We're doing okay.
We'll see, Marianne.
Well, Bob, this has been such an insightful and really an informative conversation. I want to thank you very much for joining us here today.
Been a pleasure.
And I want to thank all of you for tuning in as well.
Thank you for watching or listening to the Friends of Sanctuary podcast. Tune in next month to be sure not to miss out on the next installment of the series.
Securities offered through Sanctuary Securities, Inc., member FINRA SIPC. Advisory services offered through the SEC Registered Investment Advisors, Sanctuary Advisors LLC, and True Independence. Sanctuary Wealth consists of the wholly owned subsidiaries, Sanctuary Advisors LLC, Sanctuary Securities, Inc., and True Independence, as well as Sanctuary Alternative Holdings, Sanctuary Asset Management, Sanctuary Insurance Solutions, Sanctuary Global, and Sanctuary Global Family Office.